Income Tax 2020 Tax Software Example Standard Deduction. Come in, relax with Income Tax 2020. Here we are in our tax software, Lacerte Tax Software. You're not required to have access to the Lacerte Tax Software, but we're going to be jumping back and forth from the data input to our forms here so we can see what the adjustments will be as we change things, such as the filing status. We're focusing in on the changes to the standard deduction. So if we go back on over here to our standard deductions, the way we want to think about them is typically single, or the main, I would think of the main premise or main standard deduction per person generally would be the $12,400. If married, we double it to $24,800. And then of course, if we break it back up again to married filing single, we're back down to $12,400. If we have qualified widower, $24,800. If there's head of household, we're going to be in between. We're not exactly doubling the $12,400, but we're somewhere in between doubling. So 12, which would be the $18,160. And if older than 65 or blind, we're adding another about $1,500 to it, or more specifically, $1,300 married filing joint, $1,650 head of household. So let's just test these out, and we'll do this fairly quickly because we've seen the filing status impact on them before, but we want to now focus in on not so much the filing status, but the standard deduction, which then will be, if we scroll down, we're starting off with 100,000 of wages, just simply W-2 wages here. We have a single taxpayer at this point in time, so we have single status. This is going to be Eric Smith, our taxpayer down below. And then if we scroll down, then we're going to have our deduction that we're focusing in on, the $12,400, and that's going to be our standard deduction. So that's what I would think about as the default standard deduction. If we did it in Excel in our worksheet, 100,000 income minus the 12,400, which we're pulling from here, our standard deductions down below, that's going to give us our taxable income of the 87.6, and that's really where we're concentrating on at this point in time. So if I go then to page 2, then you're going to have the tax that's going to be calculated on that. But the tax calculation will change, meaning the rates will change based on the filing status. But what we're really thinking about here is what the impact will be on the standard deduction, not really on the tax rates. But just realize, of course, if we go from single to, say, head of household or married filing joint or something like that, then we could have an impact on the standard deduction, and the tax rates themselves will typically have an impact as well. So now let's go up and say, okay, the next common one would be going from single to married filing joint. So let's say we go to married filing joint. We're going to go back on over and say we're going to add then a married. So that means now we have two people that are filing on the tax return. We're going to keep the income the same at that 100,000 now. And now we have two people on the return. So what you would think then is that the standard deduction should double, because we shouldn't be penalizing people for getting married if they both have the same amount of income and they come together and file on one return. You would think the deduction, the benefit that they would have of the deduction would double. That's what happens. We're now at the $24,800, bringing the taxable income to $75,200. If we did that on Excel, same thing. We'd say the 100,000. Now we're picking up the standard deduction of the $24,800, which takes us to the $75,200 here. That's where our focus will be. Now note there's an impact on the tax calculation as well, not simply because the taxable income went down, but also because the tax rates changed. So when you're thinking about the filing status change, you're thinking standard deduction will change and the tax rates will change. So this decrease in the amount of actual tax calculation is not simply due to the standard deduction, although that's a component of it. It's also due to the fact that tax rates changed. Going back up, let's try a head of household one. So let's say, okay, let's change it then to the head of household. So we're at married. Let's go ahead of household. Take a look at that change. So for that, I'm going to go back to the client information. We're going to say, let's pick up a head of household, which will typically mean that they're going to have a dependent as well. So let's go ahead and add a dependent. Let's add a dependent of Tom Smith, Social Security, our date of birth 06/15, let's say 19, and then we're going to say 444444444, relationship son, and this is going to be applied when applicable. Let's take a look at that and say, okay, let's go back to the forms. Now we're at the head of the household, and then we got the same 100,000 up top, concentrating in on the standard deduction, now changing to the 18,650. That brings our taxable income to 81,350. If we see that in Excel, then we would simply change the standard deduction here to the head of the household, HOH, and that's going to give us the 81,350. Once again, that will have an impact, of course, on the tax calculation over here. So the tax has then changed, but if you move from, say, single to head of household, then again, there's two things involved. One, you can have a bigger standard deduction, or two major things. You can have a bigger standard deduction, which does have an impact on the tax, lowering the tax, but you also have the impact of the fact that the tax tables have changed as well. So those, you got to keep those two things in mind when thinking about the actual calculation or impact on the tax return. Obviously, if you have a qualifying child as well, you might have a child tax credit and earned income credit that could be involved in it as well. So if we go then back up top, let's try the qualified widower. If I go back on over and say, okay, so now we're going back here. I'm going to say, all right, we have a dependent, and now we're going to say qualified widower, and check that out. So I'm going to say, all right, what does that do? Qualified widower, this is more uncommon of a filing status, of course, but we see down here that it's going back up to that 24,400. Again, basically in essence as if married. So you got, if you're widowed in the year of death of the spouse, then you typically filed married filing joint, and in the 2 years after, if there's a dependent related and you qualify for qualified widower, then you basically get the benefit of the standard deduction as if still married, rather than being sent back to the single filing status. All right, let's go back on over, and let's remove the dependent here. Let's just check out and say, well, let's say dependent's gone now, no dependent. And then we're going to go back to the client information, and let's bring it back to single. Let's bring them on back to single here. So now we're single again. A lot of action going on with Eric. He's single and married and widowed, really. So then we're going to say that, let's say that Eric's over 65, let's say. Let's change the date here, 19, let's say 53. And then I'm going to say, all right, so let's go back on up. So I'm going to go back to the forms. So now we're at the 100,000 once again on the page 1, and let's just take a look at the 1040 right now. So we're at the 100,000, and now we're at the 14,050. The 14,050. So that's going to be that'll give us the 85,950. So then we could put that over here, and we might need to add some categorizations down below just to pick those up if over 65 or blind. So let's take a look at it this way. We'd say, okay, it's going to be equal to, if they were single, it would be for the 12,400 plus over the 65, and single, that's going to be another 1,650. So now we would be at the 1450, bringing the taxable income to the 85,950. So that's going to be the 1450, bringing the taxable income to the 85,950. You can see it here on the 1040 SR. So it's a little bit different of a format of it, but the adjusted gross income, and if I go to page 2, we've got the standard deduction or itemized at the 1450 to give us to the 85,950, the 85,950 here. So that looks good. That looks like what we would then expect. Let's go on back over. Let's go back to the 1040 first. And if we did the same thing and said now they're not 65 but blind, we're going to say, all right, let's bring it back up to not 65. We'll say, let's bring this back up to like 77, so not over 65, but we check this little checkbox off, say blind. Then we're going to say, all right, what happens then? So now we're at the 1450, same kind of thing, same calculation here on it. Now we're at the actual 1040 is the standard form here, but we have the similar impact. So the 1450 is the result of picking up the single plus the 1,650, not because older 65, but because blind. So we're going to say, all right, and then if we did that same kind of thing for married, let's say married, and if I say married filing jointly, so married filing jointly, and so if I go back on over, then that's going to bring us to the standard deduction of the 26,100, because again, we have a blind there. So if I was to say, okay, this is going to be married filing joint. So married filing joint plus we're married, so that's going to be another 1,300. And that gives us the 26,1 for the 73,9. So 73,9 is here. So there we have that. And if I go back on over, notice that if I say clients, that's going to be for this individual, the taxpayer's blind. Let's say blind on both here. So if we say they're both blind, then if I go back on over, we're going to say, all right, now we're at the 27,400, right? And that would be then if I take the standard deduction plus the 1,300, and now there's two people that have the added 1,300, so that's the 27,400, bringing us to the 72,600. So that brings us to the 72,600 there. So that makes sense. And then let's do the same thing and say now not blind. Thank God. Let's go to say they're both over 65. So let's say then we're going to say, let's say they're both at 1953, and now not blind, and 1953 and not blind. Okay, so then I'm going to go back on over. So they're both over the 65 now, and we're still at the 27,400. We have the 1040 SR, but if we just look at the 1040, there's the 27,400 again, calculated as basically the married filing joint. And then you've got plus 1,300 plus 1,300 because they're both over 65, right? And if you said if only one was over the 65 of the two, then we'll say that this is the taxpayer's a lot. We'll just say we'll say 77. One's over 65 and one is not. Then we're at the 26,1. 26,1 calculated as, this would be then equal to the standard deduction for married filing joint plus 1,300 added amount for the 26,1 to bring us to that 73,9. So that brings us to the 73,9. So there's that. Now let's go back to single. Let's say, okay, well, what if I went back to single here and said, go back to single, and say the taxpayer is not over 65 or blind. That brings us back to the 12,400. And then if you imagine the itemized deductions on Schedule A, you're imagining, well, is it worth me compiling those itemized deductions? Well, they have to be greater than 12,400 to benefit. They have no benefit up until the $1 after 12,400, because that's the only time that they would have a benefit. So, for example, if you then go to the standard deduction, Schedule A, and somebody says, I have medical expenses, I've got, the taxes and whatnot. What's the impact of the taxes that I'm going to pay? Interest that you paid, gifts to charity. Now, there's another kind of component, which is a smaller component for gifts we'll talk about later, that you still might get a benefit if it's not on the Schedule A, but typically gifts here, casualty losses, and then other itemized and so on. If they mention any of these items, and they're not close to the 12,400 or 24,800 if married, then you're like, okay, you might get we can check it out. I'll add it to the tax return, but I don't think there's going to be an impact on the tax return for it. And you want to be straightforward with that, because you don't want them spending all their time gathering medical expenses, which are severely limited with both a 7.5%, reduction or hurdle that has to be going over, and with the fact that you have the fact that they got to go over the itemized. So when you think about these items, just note that the major things that will typically increase it are usually a home mortgage. So if someone has a home and they have the interest that they're paying on the home, that's a major component that could be taking people over. That in addition to a high state tax, like if you're in California or New York or something like that, those two things combined are usually the things that push people over, because they're going to be paying property taxes on the home plus the home mortgage, both in a very high cost area, and those things could then be pushing you over. Then the medical expenses may be beneficial, even though there's still a problem here and a cap that has to be going over. So let's just say that we had the interest. Then let's go to the itemized deductions and say, all right, Well, if so, and when you're thinking about this, you're basically saying, okay, medical expenses, they might help, but if they don't have a home mortgage or nothing, then it's likely they might not go over the standard, is what your mindset might be. So if I went to the itemized deductions, then for example, and if all the itemized deductions, let's just put the home mortgage interest. Let's go to the interest here, and just say that we had home mortgage interest of, let's say, 11,000, and then I go back on over to the itemized deductions, and if that's my only itemized deduction, that's going to add up to the 11,000. If I go back to the 1040, then it didn't help me at all, right? So I'm still at the 12,400 because it's not going to help me until it clears 12,400. If I had then the home mortgage interest was 15,000, and again we'll talk more about these itemized deductions later, but this is just the relationship with the standard. Now I've got the 15,000. Now you can see that Lacerte made it black because the Schedule A is relevant now. Before it was not. Once it's relevant, which will typically often be because of home mortgage interest and possibly taxes such as property taxes, state taxes, which are deductible for the Fed, then you start saying, okay, now let's go and make sure that we're picking up any medical expenses that might be over the threshold of the 7.5 that we'll talk about later. Let's pick up the charitable deductions and whatnot. Make sure that you're adding all those together and everything from that point in time. So that's the relationship with the itemized deduction. Now, if I jumped over to married and say, well, now they're able to utilize the itemized, but what if he got married? Married filing joint, back to the forms, and okay, and now no longer a benefit. Well, let's go to the 1040, even though. So now it's no longer a benefit because it's at the 26.3. Let's bring it back to the standard. Not over 65. So I'm going to say this is going to be, she's back to 77 at the year, so she's not over 65. So now we're back to the 24,800. So, and the itemized deductions are no longer beneficial because now the standard deduction is greater than the itemized deduction. So that's kind of the relationship that you have there. Also, just note that, of course, if the taxable income is below the standard deduction, then you're not going to have any tax, of course. So, I mean, if the W-2 income, if they're married, and then your income here on the W-2 was the taxable income that you have, whatever the taxable income is less than, you only had 20,000 here. And this could be the case for retired folks who might have money that's saved up. They're dipping into retirements that's non-taxable income possibly or something like that. Well, then now they're below the amount. And usually you can think, well, maybe they don't need to file if they're below the threshold, possibly like students or possibly people that have some other income source. They might not have a lot of taxable income. And you might think, well, maybe they don't need to file at all at that point because the standard deduction possibly would be lower than the amount of taxable income. And that might be the case. Just realize that also, however, for those individuals, then they might, even though their tax is now at zero, their taxable income is at zero, they're not paying any taxes, they might qualify for a child tax credit still. They might have some money that they put in, that they paid with their W-2 income, that 20,000 might have had withholdings on it that they can get back, and they might qualify for an earned income credit. So because of those things, they may still want to file. So if someone has low income and it's below or close to the threshold of the itemized deductions, then you're thinking, well, taxes are going to be really low, but maybe they're going to get refundable credits. Maybe they get an earned income credit, maybe they get a child tax credit, and maybe they get anything back that they withheld on the tax return.